In collateral damage of sorts, turbulence in the US and European banking sector has led to a negative rub-off effect on Indian banking stocks. In March so far, the Nifty Bank Index has slid 3.3%. Even before the Silicon Valley Bank, also known as SVB, crisis erupted, the index was trading on a weak note. In this video, we'll explore the factors that make Indian banks different from their troubled US counterparts and why they may be better positioned to weather the storm. Concerns over the implications of the sector's exposure to the Adani Group has also kept investors edgy. Along with Credit Suisse's problems, news about SVB and how it might affect the tightening of global liquidity has only made things worse for investors. There are worries about potential contagion risk. However, experts suggest that Indian banks are on a relatively firm ground with a good capital position, funding, and liquidity. India has seen a much lower increase in bond yields and interest rates. Indian banks are vastly different versus troubled US banks in several important aspects, said analyst from Kotak Institutional Equities in a report. The types of deposits are seen as a key way to avoid a situation where there isn't enough money. Indian banks have a higher share of retail deposits than some US banks that are seeing large deposit redemptions, according to Kotak's analysts. Concern about large unrealized losses in US bank bond portfolios fuel this. Retail deposits are stickier than wholesale and corporate deposits. According to the Kotak report, Indian banks' bond books are mostly held to maturity securities. Held to maturity securities must be held until maturity. Also, analysts note that Indian banks have a good capital position which helps them during crisis. According to Moody's Investors Service, Indian banks have faced severe solvency issues in the past decade, but their funding and liquidity have held up well and supported their credit strength. Furthermore, the Reserve Bank of India's relatively lower quantum of interest rate hikes than the US Federal Reserve may also avert a scenario of greater financial stress for banks due to tightening liquidity. But that doesn't mean Indian banks are immune to downside risks. With rising interest rates, the cost of funds are inching up as deposits get repriced. Consequently, the sector's net interest margin, which has lately been a comfort point for investors, is poised to come under pressure. Along with that, the chase for mobilization of deposits could also get intense. With the overall level of inflation hurting urban consumption and sluggish rural recovery, trends in credit growth are crucial. The latest data published by the RBI showed that credit growth for the fortnight ended 24 February was at a 15.5% year-on-year. This was slower than the 16% increase seen in the previous fortnight, which ended on February 10. With rising rates, the drop was anticipated. In conclusion, while Indian banks may not be entirely immune to the impact of global financial instability, they appear to be better positioned than some of their US counterparts. Indian banks have kept their fundings and liquidity even during crisis by focusing on retail deposits and securities held to maturity.